Welcome to Straight Talk and Retirement. Your no-hype source for financial advice and making informed choices about your retirement planning. Get on the phone to talk today at 314-931-5877 or text your question to 84126.
The opinions voiced in this show are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial advisor or tax advisor prior to investing. Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Private Advisor Group, a registered investment advisor. Private Advisor Group and JBL Financial Services, Inc. are separate entities from LPL Financial.
Now, here are your retirement coaches, Jeff and Erin Lapidus.
Well, hello, St. Louis, and welcome to Straight Talk on Retirement. You're live and local, St. Louis's favorite financial call-in show. I'm Erin Lapidus, president of JBL Financial Services, financial planner and wealth manager, and I'm joined this week and every single week by my dad, Jeff Lapidus, wealth manager and retirement coach, and my husband, Robert Markham, our life insurance and fixed annuity sales specialist.
Good morning.
Good morning, babe.
Good morning. We help our clients make smart choices about their money. The way we do that is by designing a game plan, a written step-by-step strategy, a real game plan with several goals in mind.
First is to preserve, protect, and prudently grow the assets our clients have taken their entire lifetimes to accumulate.
Second is to provide an income stream they can rely on so they can do all the things they want in retirement.
And third is cost-effectively addressing their health care needs, like helping individuals enroll in Medicare and choosing the right plan to couple with their Medicare coverage.
And then when they're done enjoying their assets during their lifetime, we show them how to pass them on to the people they love, whether it's their spouses or children, grandchildren, churches, or charities, whoever it might be, without Uncle Sam or the tax courts taking a big bite out of their money. And as their wealth managers, Erin, Rob, and I watch their money every single day to make sure they're staying on track. And that's why they call us the retirement coaches. Well, gang, good morning.
Good morning.
Nice to be here in the new studio.
Very nice. Very plush.
And fun. Thanks so much for tuning into our 2-hour show today. We have a lot of things on our mind. What's more important is, what's on yours? Give us a call today. We'd love to hear from you. 314-931-5877 or 84126 from the text line. As Erin mentioned, all of our clients are folks like you. They're our listeners. They're 55 and older. They would like to retire, or they're already retired. And our goal is to create a game plan for them so they can have a fun and financially successful retirement. And just as a point of information, there are lots of ways that you can keep in touch with us during the week.
That's right. Log on to our website, jblfinancial.com, and you can click on the Contact Us button in the top right-hand corner and request a coaching session, financial, Medicare, or both. Or you can click on the pop-up box that appears that says sign up for our monthly newsletter. We call it the Coach's Corner. And you can access it every single month by putting your name, email address, and phone number into the contact information, or sending Robert an email, robert@jblfinancial.com, and he will add you to our email newsletter list. And why don't we talk a little bit about, I think this is our last Saturday of April.
It is, and we've got some great articles in the April 2026 newsletter that you're sure to enjoy. The first one being, what do Americans do with their tax returns? Almost 100 million Americans will receive refunds. The average refund is a little over $3,100. What are they going to do with all that money? We've got a great infographic at the bottom half of the article laying out just how they intend to spend that. And I notice only 3% plan on a major purchase, i.e. car or appliance. I was hoping they were going to splurge a little bit more with that money. And our second article, Be Storm Smart, How to Prepare for Extreme Weather. Almost 1/3 of U.S. homes are exposed to at least one type of extreme weather risk. Can't control the weather, but we can control how we prepare for it, and it starts by knowing evacuation routes, having perishables, water, canned goods on hand, flashlights, batteries, anything you might need if you were without power for any length of time. We also want to make sure that our insurance coverage can weather the storm. So that might mean taking pictures and or videos of family heirlooms and or jewelry, appliances, so on and so forth, so you can have a complete catalog of what you have and care to have replaced. God forbid you should be in the grip of some storm damage. And our next article, are stocks expensive? Look at the PE ratios. If you watch any financial news or read any financial stories, you'll hear a lot of opinions about, stocks are overvalued, they're undervalued, they're priced about right. What is the basis for these observations and opinions? Well, one of the most common ways to measure a value of a stock is to look at the price-to-earnings ratio. For example, a PE ratio of 20 means that investors are willing to pay $20 for every $1 of earnings. So by that ratio, a stock with a PE ratio of 25 could be considered more expensive than one with a PE of 20. And it's important to remember that we want to compare apples to apples and oranges to oranges. So what we want to compare when we look at PE ratios is companies within certain like-minded industry groups. So what we don't want to do is compare, say, a high-flying information technology stock to, say, a utility or a mining company. We want to compare apples to apples so we can get an accurate representation of just what's what and who's who. And, of course, before we make any changes to our portfolio because of PE ratios or any metrics for that matter, we want to sit down with a professional and make sure that any changes are going to be in line with our risk tolerance, time horizon, and, of course, financial goals. And our last article, how AI is helping the IRS modernize. After years of slow audits, taxpayer frustration, and endless paperwork, the IRS has begun to leverage artificial intelligence to, number one, help detect fraud earlier, and to provide better taxpayer service, whether that's reduced wait times, freeing up agents to work on complex issues that require human intervention. Whatever the case is, these strategies and technologies are being leveraged, and they're already paying dividends. In 2024, the IRS recovered $4 billion in what would otherwise be improper payments or fraud detection. So we can see that these efforts are already beginning to pay off, and as they begin to leverage more and more AI tools, we can expect to see more of it. And that is your 2026 April newsletter in a nutshell. And just as a reminder, if you send me an email at robert@JBL Financial, I'll make sure that you get our May 2026 newsletter, which will come out, I believe, next Friday. So be on the lookout for that.
Fantastic.
Sounds good. And again, Robert does keep the last 12 to 18 months of those archived for reviewing, printing, or downloading convenience. And as a reminder, we are live and local. We'd love to hear from you. Our phone lines are open, 314-931-5877 or 84126 from the usually hot and heavy St. Louis text line. It may be that folks are still sleeping because of the draft.
They're up late watching the draft.
Well, et cetera. I mean, we don't have a home team, so they're watching their other home teams, right?
Sure.
They've got to shorten those times in between picks. I mean, 8 minutes, it can drag a little bit. It's like, come on, guys, you had months to think about this.
Make a decision.
I thought they were pretty quick. I thought the first round was pretty quick this year. It seemed a lot quicker, and the second and the third round were just, they were lightning speed.
It is really fast when you fall asleep.
Yes. Time goes by when you're having fun.
That's right.
Again, our phone lines are open. We'd love to hear from you, 314-931-5877 or 84126 from the text line. So while we're waiting for your calls.
Well, we don't have to wait long because we've already got a few texts
Beautiful.
On deck.
And our first texter writes, can you share once again the best approach to taking cash when the market is up? Say 20 to 40,000. I have 20 to 40,000 in a savings account, and my IRA is over 1.5 million. How would this affect my RMD for 2026?
So if you have a required minimum distribution to take this year and you are in need of cash, let's go to the IRA first, especially if you aren't going to naturally meet your required minimum distribution for the year. So, for example, if you're already taking monthly income, but you're in need of, was it $20,000 to $30,000 of additional cash?
$20,000 to $40,000.
$20,000 to $40,000 of additional cash. If you're already taking monthly income, Let's subtract that from what your requirement is. So let's use a nice example and say that with a $1.5 million IRA,
about $60,000
at 73. So we'll say that $60,000 at 73. If you're taking $2,000 a month, that's $24,000 a year. So that means we're at $36,000 rather of additional income need, of additional need before we get to December 31st. To satisfy the IRS. That would be the first place I go. Let's pull the balance if you're in need of that additional income, that $20,000 to $40,000. The timing is another conversation as well, which is, first of all, you're already taking monthly income continuously. So if you are in need of that excess, I would recommend taking it when you need it, right?
Yes, and even be event specific. Like we have and we're going to talk about somebody else today where many of our clients have real estate taxes that are due at the end of the year because they've paid off their homes.
Right.
Maybe they have vacation plans.
Sure.
Maybe they're wanting to make gifts to people.
Maybe it's all of the above.
Right.
Right.
So we have a few different points in time in which you might need excess cash. Our texter has a savings account with, was that $40,000 in it?
Little over 100.
Oh, over $100,000 in savings. So if you wanted to break up the balance of what you have to take for required minimum distribution over several of these points of need, you could supplement with the savings. We'd also recommend that if you are in need of cash throughout the year, that you're pre-planning for that. If you're doing your own investing, maybe you already have dividend-producing securities. They could be individual stocks or mutual funds, ETFs, whatever the case is. Most people have those set to reinvest automatically because you're just wanting to build your portfolio. Well, now you're taking income. So maybe it's time to manipulate the securities that produce dividends to tell those dividends to go to cash. That way you're starting to build cash in your account, and it'll be there and ready for you to take it. Now, we know that the average dividend yield on the S&P is about 2%, so it's probably not going to produce all of the additional need that you have every time that you need it, but it's going to be one way to assist. The other thing we would recommend is put dates on these needs and these events, and then we can start to plan to siphon cash on a consistent basis to get that bucket filled for what you need. Because our goal ultimately is to skim gains. So if you were invested last year, chances are you saw positive returns. Depends on your mix, right? What those returns were. Most likely, even through the volatility that we've seen at the end of last year and the beginning of this year, you're probably, if you are back in the green again, that means you're living off of gains. So maybe it's the opportunity to say, I know I'm in need of about $40,000 this year. I'm taking my dividends to cash. That's going to produce X, and I'm going to start every month siphoning a few $1,000s to the side to get me to the cash need that I have. And then that way you can truly live off of the gains, continuously pull from the portfolio. There's never going to be the best right day to do this. You would have to have a crystal ball. And the truth is, when we're looking at required minimum distributions, what you have to take, I just received this question on Friday. When's the right time to take it? Should I leave it in the account and let it grow as much as possible? Well, if you're pulling a relatively small amount against a larger portfolio, it's unlikely that a 1% distribution is going to have a long-term impact on returns. Let's just think about a dollar amount. If you said you were going to pull $10,000, even if you left that in the account for the whole year and you had a fabulous return of 10%, you're still looking at $1,000.
Yeah, honey, I think you make some very good points here. At the same time, it does make sense to at least once a year rebalance your portfolio to get you back to your risk tolerance. And so when we talk about skimming the gains, that's one way that we're able to do that. Having gains or rebalancing, that does create excess, in theory, a cash position.
Sure.
Which could then be distributed on a timely basis for you. So there's never a right day. I mean, that's what it really comes down to. There's never really a right day. But again, if you can, as Erin was saying, identify certain needs for cash at certain times during the year, and you know that this cash is going to come because you have your RMD coming, let's time it to those needs. And then let's also maybe incorporate a rebalancing strategy. Maybe it's once every 6 months. We rebalance our client portfolios twice a year.
Right.
So, if you're saying, hey, maybe I'm doing this in July as a rebalance, maybe I'm then doing it January 1st, after January 1st as a rebalance.
Part of your rebalance will create cash.
Exactly. It should create cash, and therefore those can be then distributed at the appropriate time. And the last one we really didn't talk about was qualified charitable donations, which is the ability to reduce the taxation on those requirement of distributions by permitting your IRA custodian to directly send those charitable contributions for you. Again, doing what you're already doing, but doing it more tax efficiently, because those numbers come off the top.
Right.
And what's kind of fun is I know, at least with our custodian, there's no fee involved here. So whether you want to do it, we have some clients that are in the clergy. We're sending monthly tithe. We're sending their tithes monthly to the church. We have other folks that are, say certain golf events or it's during certain times of the year. So we're making sure that we're making that contribution to that charity at that specific time.
For most custodians, this is just paperwork.
Right.
So you want to get with your advisor or the bank that is holding your IRA account and let them know what you want to do, and they will let you know what the potential limitations are. For example, we have clients that send it out quarterly, people that send it out at a specific time once a year, people that are doing monthly donations. You can do a variety of things, and at least with our firm, and you can change them on an annual basis. Nothing's set in stone.
And that's fun because we know that, I guess I would say one of my chief duties at this point is to talk to every one of our required folks that have requirement of distributions, talk about where does the money go? Is there timing for it? Are we recycling the money back into your investment account? Are we bringing it home, and how are we going to take it? So do a little planning.
Right.
It can really be fun, and frankly, what you can do is take the stress off. If you think about it, you can take the stress off of your daily budget by knowing that we have a certain amount of money that is going to be coming in, and then planning for that. That was a great question. Again, I know we have some other text questions, but just to remind everybody, our phone lines are open as well. We'd love to hear from you, 314-931-5877 or 84126 from the text line.
And our next texter writes, can you talk about the new Trump accounts and who is eligible?
New Trump accounts are for the little babes.
Infants.
Right. The little babes that were born.
Newborns.
Between 2025 and 2028?
Yes. So to begin, if you have a new member of your family January 1st of 25 forward, those are the babies that are eligible. There is a government website. So if you type in Trump account into your Google browser, it will direct you to a government website where you can set up your Trump account. Then once the account is set up, and by set up, you'll create the account plus make a contribution. Once the contribution is made, you can go to your advisor or your custodian, wherever you're holding all of the rest of your funds, and have those funds transferred into a new account that is still considered a Trump account, but you could have someone manage it for you. So you have to initially go through the government website to
get their money.
To create the account, have it registered, and then it can be transferred. There are no taxes or penalties to do the transfer, but it just has to originate through the government site, and then you can work with your advisor to move the funds over. You are still eligible to make contributions once the funds have moved over and you've created the new account. It's just the point of origin has to be the government site. Now, everyone is technically eligible to open a Trump account. It's just if you were not born January 1st, 25 forward, then you're not eligible for any of the matching.
The $1,000.
The $1,000. You're not eligible for the government cash. So if you're someone that's thinking about this, you might want to have a longer conversation with your advisor about what the advantages and limitations are of these accounts when you create them, because there are other options if you were trying to create money for a child, a grandchild, a friend, a relative, whatever the case is. You have a lot of options in how you're either going to pass money on, create money for that person while you are both alive. So this is a nice option, but it's not the only one.
I think folks need to realize that these are basically IRA accounts. Mm-hmm. And you're creating it for somebody that's obviously less than one. So they're really going to follow the IRA rules. in terms of early distributions, penalties, etc.
They do have a little bit more flexibility, right. In those distribution rules. So, like, I know, and these are still evolving, but the top college education is one that you can distribute for.
Right.
The creation of a new business. Now, that's an interesting one because obviously the IRS hasn't had the opportunity for any commentary on this quite yet. What are the parameters of that? You might want to consult with a tax professional to get clarity, but that's an option, like being able to start a new business is one. And I believe first-time home purchase is also a reason for distribution.
And I don't know if we're even prepared to do this at this point.
I do not know if LPL, our broker-dealer, has created the ability, the platform for the Trump accounts quite yet. However, if you're someone that's working with us and you want to talk about the Trump accounts, we know about them. We can help you get them set up. And then when we do have the capability to move them, we'll be happy to help. But no reason to limit the options. Just if your custodian doesn't have access, you still have access. So usually these things take a little bit of time for everyone to catch up. Just like, for example, the Secure Act, created the simple Roth IRAs that are available now for small businesses. It used to just be a simple IRA. Roth 401ks have been in existence for quite some time now, but smaller companies, their employees didn't necessarily have access. And now that that's been rolled out, it's taken a couple of years, but now we have access to simple Roth accounts if people are interested. So
Roth is never simple.
Not with you.
No, it isn't. And I have to think about that.
What do you mean?
No, I don't.
Oh.
Well,
I was going to say, it seems like a really definitive, your reputation precedes you to the point where when new folks come in and I'm chatting with them, they'll say, now I know your dad doesn't like Roth conversions, but, and I said, don't worry, nothing's recorded in this room. We won't let him know. Well, tell me about your plans to convert.
If it makes, I think the biggest issue that I have in hearing folks talking about Roth conversions is that they want to do them while they're at work.
Because they hear other people are doing them.
And frankly, that is the worst time to do it. If you think about it, most likely the year to 1 to 2 years before you retire, you're probably in your highest earning years, your highest effective tax bracket. When you retire, you'll be in a lower tax bracket. We know that. We've seen it. Only, thousands plus times.
The majority of the time, and even if you have very strong pension and Social Security benefits, so you have a very strong fixed income base, we're still seeing people at least fall to the bottom of the bracket that they're in at the minimum. So we're creating more space.
Right. So the time to do it is when you're in a lower effective tax rate than in the higher one.
Or you have more, or at the minimum, you have more room in the bracket that you're in. Like if you're in the 22 already, but you're at the very top, why bump yourself into the next bracket?
Because a Roth conversion is different than a Roth contribution. Different. You have to be, you can be any age to do a conversion.
Right.
And, obviously the younger you are, the dumber you are. But, in terms of making a contribution, you have to be in a situation where you have earned income.
And so that would be our first course correction. If you asked, if you were still working, if you asked us if you were still working, should I do the Roth conversion? It'd be like, do you have access to Roth at work? Many companies now offer Roth 401k. Why not just make Roth contributions as opposed to converting to Roth while you're still working?
Okay.
Right. I mean, it's not going to it's not going to reduce your tax bracket, but at the minimum, it's not going to increase your tax bracket most likely either. You're just going to take money you were getting a deduction for and now pay taxes on it.
Yes, I agree.
Yep.
And our next texter writes, can you explain price to earnings ratio in more detail in layman's terms? Is earnings basically a company's profits, what the company makes after all expenses, and why is this a big factor in choosing stocks?
It's a great question.
Well, the most fundamental way of looking at it is PE ratio is the stock price divided by the company's earnings over 12 months. Companies with PEs are expected to grow at a higher rate, so any hiccup in those earnings could lead to a very volatile stock price. On the other side of it...
And we're talking about earnings before interest and taxes, correct?
Correct. And on the other side of it, companies with very low earnings are expected to be rather smooth and predictable in their earnings performance. And any, say you had a utility that grew at 50% in the latest quarter, they could see an appreciable jump in their stock price because that's very unusual for a, we'll call it a legacy industry.
I thought you made a good comparison while we were talking about the newsletter, which is the utilities. So usually low PE ratios,
right?
Good dividend payers, consistent stock prices, so that they're not usually seen as growth companies. Now sometimes they outperform and you get a nice bump, but when we talk about like the Mag 7, we're always looking at they have very high PE ratios because they're expected to have
you're paying a premium for those stocks because they're growing at such at a prolific rate that they're carrying higher PE ratios because that's why you're paying the premium. And
now this gets called into question when we start to see PE ratios
that
go
are elevated.
Outside. They're not only elevated, but they're outside what we would consider the norm. There's several standard deviations above what we see as, potentially like even in a bull market, sometimes we see the PE ratios get a little overextended.
Well, you just see that, and a lot of times we're looking at this being measured by the S&P 500,
right?
Which has a standard PE ratio around 16.
That's in a robust, that's in a well-growing economy,
exactly.
Right?
So when that multiple gets high, typically the market is considered to be overvalued. When it gets lower, then it's considered to be undervalued. So analysts are looking at these things.
Basically saying,
let's be honest. Let's be honest. If you're a do-it-yourselfer, which is cool, then you care about this stuff.
Sure.
If you're not, your advisor cares about this stuff.
And also, I think it's a nice guide. I think that the newsletter is an excellent guide for when you're listening to this stuff on CNBC or wherever you happen to consume your financial news, or when you're sitting down with your financial advisor and maybe they're using some language that you're not super familiar with, and we've all been in those situations where we just kind of let it pass by. This might be your opportunity to say, hey, I've got a working understanding of what this person is talking about.
Yes, and again, the market does change. Look, we know the markets move daily, but in terms of trends, that's really what we're looking at.
Sure.
Is the market becoming overvalued? Is it becoming undervalued, et cetera? And so that's something that would be of concern maybe for you to think about. And again, it's a good piece of conversation, but have a little fun with it. It's good to have. The more information you have, the better of decisions you can make. And that's really what this is all about. Giving you a little more information.
Or why don't we take our first break of the hour? It looks like we've got a few more text questions on deck, so we will certainly get to those. So don't touch that dial. We'll be right back after these messages.
This is the Big 550 KTRS St. Louis, Alton, Valley Park, St. Charles, and the world.
Streaming live at KTRS.com.
It's springtime, so make some spring cleaning and clear out some room for Dogtown. Dogtown Pizza, of course. Take those freezers and deep freezes and stock them full of Dogtown Pizza. With plenty of sports and warm weather action coming up, you'll want to make sure you always have an emergency pizza on hand. And with 12 different varieties, you're going to need to make plenty of room. Bacon, 4 meat, and the veggie. Clean out those freezers to make plenty of room for all the Dogtown varieties. And to see a full list, check out dogtownpizza.com.
Hey, gang, the show heads out again this Thursday. We're going to Easter Fence and Deck. In their third generation of work, almost up to 70 years of making great fences, which, of course, make great neighbors. Meet Chuck and the gang. Julie and I will be out there as well. 6071 Lee May Ferry Road. Or find out more about what they do and how they do it at EasterFenceInc.com. That's live Thursday from noon to 3.
This is Jeff Lapidus, the retirement coach. Wouldn't it be great to have a game plan, a real strategy, so that no matter what was going on in the stock market, the economy, or the world, that you could be confident about your retirement? Wouldn't that be great? If you're within 5 years of retirement, call me today at 314-863-0008. That's 314-863-0008. Or send me an email, jeff@jblfinancial.com, to arrange your free coaching session. Let's get started on your retirement game plan today.
Every day another adventure. Our greatest discoveries come when we stop searching. Beneath the endless sky, away from the stress of work, the answer to the ancient Zen mystery, the sound of one hand clapping. Take a trip in an RV from Byerly in Eureka.
For the rest of your life, you gotta be there. Byerly RV.
The views and opinions expressed in the following paid program are those of the host, callers, and guests, and do not necessarily reflect the views or positions of this station, its management, or owners. Let's talk about smart choices for your money. It's Straight Talk and Retirement on the Big 550 KTRS. Here are your retirement coaches, Jeff and Erin Lapidus.
Well, it's 9:36 here on the Big 550 KTRS, Talk Radio St. Louis. I'm Jeff Lapidus, the retirement coach.
Erin Lapidus, the retirement coach.
And I'm Robert Markham, your life insurance and fixed annuity sales specialist.
And we are willing, waiting, and wanting to answer your questions at 314-931-5877 or 84126 from the hot and heavy text line. You know, we've had some nice texts so far this morning.
Yes, we have. Nice variety.
Love it when the audience is engaged. And speaking of the audience, they have another text question. And texter writes, what percentage of your clients' accounts do you have in dividends? Or do you recommend dividends when your clients want monthly income? Do you put them in dividend-bearing portfolios? Great question.
No.
I agree with that. I won't speak to a specific percentage. We do have a component of our portfolio that is focused on value investing, which usually incorporates a dividend component. We do have many clients that in their after-tax accounts are holding dividend-producing securities. So like we talked about earlier, we might be setting those to cash to create additional income. But our general philosophy is asset appreciation, meaning we want to lean towards the growth side of the S&P 500 while the market allows us to. So over the last 10 plus years, we've really seen growth outpace value. So asset appreciation outpacing dividend production. So we want to lean with the direction that the market is giving us. The average return on the S&P is 8%. The average yield is 2%. So it gives us a better opportunity to meet our targets, and then we'll skim the gains to create income for clients on a monthly or annual basis whenever they're in need of that. But we obviously do combine some dividends.
We call that rebalancing.
Right.
And that really fits together with our rebalancing philosophy. So every 6 months we're attempting to skim gains and then obviously creating cash if needed for income purposes, et cetera. So we don't lean on a dividend portfolio because, as Erin's saying, the yields are too small.
Mm-hmm. If that changes, then that gives us some opportunities. But
it does. But I think philosophically, let's put it this way: the nice thing was as interest rates began to come off the floor
mm-hmm.
and rise to, they were up to 5% at one point in time, but now they're certainly lower than that. Our clients' savings we're making interest, which was great.
That's right. All savers were really, right. Luckily it wasn't just our clients that received the benefit of that. All savers were really rewarded.
It felt like the punishment was over.
For a short time.
Exactly. And so now we're back to a smaller rate of interest, but again,
elevated from where it was.
Over zero. And, again, there is security in cash, and typically things, as Erin was saying, things that pay interest or pay dividends are lower volatility than those that don't. So having a mixture of those in your portfolio makes sense, but leaning on these as the mechanism to develop the income stream for our clients, the answer is no.
Right. And we can talk about specialty cases where clients are already holding
Right.
dividend production. We're obviously going to incorporate. Basically, what that does is say, well, if we know we're going to get X amount of dividends per year, we can reduce distribution to other places because that income's already been created for us. Either why pay taxes twice, or why not take advantage of what you've created over time, which is the dividend, a position that creates a dividend that we can utilize.
Well, and then finally, if you think about it, if you're too tilted towards value and dividends, we can take those dividends and reinvest them
elsewhere
in growth.
Right. So we can use it as a...
So that we're creating more balance in your portfolio between dividends and growth.
Right. So it doesn't necessarily... Right. We might, if you joined us, we might take those dividends to cash even if you are not taking income immediately, because you have to pay... If it's outside the IRA, you got to pay taxes on it one way or the other. So why not take those dividends and instead of reinvesting to make that position larger, take the cash, invest elsewhere to create more diversity?
Yeah, I want to take us on a side note on this.
Mm-hmm.
Because this is a topic that we were going to talk a little bit about today. I had a visit with a client who just recently received their income tax return from their CPA. And this particular client is older, but she has a significant amount of dividend and interest income. She also has an account with another advisor. I'm sorry, broker, because that's really what they are. It's really it's truly a stock trading account. And this advisor is trading stocks, attempting to make gains for the client. And let's put it away, they're doing a reasonably good job.
Plus creating the taxes or the gains?
Well, both.
Okay.
So, the client isn't unhappy with the performance of the advisor, but the problem is that, and I saw this when I was, growing up. If I had mutual funds that were creating long-term capital gains, or if I was buying or selling securities, what happened was in a non-retirement account, the custodian can't withhold taxes. So you're creating this taxable income situation, but not having...
You're creating lots of little taxable events along the way, and you're not paying any taxes. So it's like you're receiving your paycheck every month, but never paying taxes on it.
Yikes.
And then what I was actually doing was I was paying the taxes associated with that from my other cash assets. So I wasn't reducing the the net returns or the net, whatever that account.
So you're actually not even, and that's an important thing to consider if you are a do-it-yourselfer like we've talked about, or you're evaluating performance. You have to net the tax liability from the gains to see what your true return was for the year, because that's another expense. Your returns, if you have, if you're using mutual funds, the expenses, so the 12B1 charges are netted from your return. So you don't see you can find out what the charges are, but you don't readily see them. It's already netted from that. If you're working with an advisor, they're netting their fee from your portfolio. The tax part comes in April, so you don't actually see that. You're going to have to go back and reevaluate to say what's the true performance of what I've done. Especially if you're doing it on your own, you want to make sure that you're not just treading water.
Well, and what was happening was, as you can imagine, this client wasn't working anymore. So they weren't generating the cash through their earnings to be able to cover over the taxes like they normally done during their working years. So I had to direct the client and say, let's go back to the advisor and say, look,
this is great, but
you're doing great, but you now have to take and participate in the tax liability that you are creating. So we arranged that at the end of each quarter, they were going to measure and then pull off some of the gains, send them in cash to the client so they could accumulate them.
So basically they're creating a little escrow account for the client to be able to pay taxes when the bill becomes due.
And we need to do that because we know that with IRA distributions that we're making,
we withhold the taxes.
We ask our clients the permission, and they permit us to do it because it makes sense. I mean, why should they do quarterlies if they don't have to? But in this case, it wasn't happening. So the nice part is that we got her back on track in terms of making sure that the cash was there, because it was interesting because as you can imagine, we went for a situation where it went 3 or 4 years where she's going, Jeff, you can send me a check for I need $50,000, I need $30,000. Like why? It's like, well, look at my return. Well, we have this tax liability. It's like, well, guess what? I'm going like, honey, we're withholding tax from every distribution we're making from your IRA. This is coming from your trading account. And so I had to demonstrate that to her. And then we got to a point where it's like, we have to do this because, frankly, what was happening is that we were using her other asset account to help fund other things in her life, and she really was literally running out of money, even though she had
more.
Also, this is financial cannibalism.
Exactly.
Also, this is a really important thing to consider if you are doing this and you have a trading account and you have maybe IRA accounts. If you come into a tax situation and now you have your trading account fully invested, you don't want to sell anything, you have your IRA account, well, now you're going to have to pay taxes on the taxes. Like, we're going to have to make a distribution from the IRA to pay taxes. You have to pay taxes on that, too, and now you're in a new year. So every year you're just adding to your next year's tax liability. Or you have to make a sale of some of the securities because you weren't in the process of the sale and the repurchase saying, well, I sold with X number of dollars, this amount of profit, I should siphon off whatever your long or short-term capital gains exposure would be. You know, if you're in the 10 or 12, if you're in the 10%, I need to siphon off 10% of this cash so that way I have it for later and then invest the balance. You're going to end up in the same situation where now you created another taxable event to pay your taxes, and that's literally the last thing we want to do.
You know, mutual funds are a little more difficult because those gains aren't basically even announced until sometime in December, and so what happens is you can say, hey, do I need my capital gains reinvested, or really should they go to cash and sit in that account?
Right. That's a little more difficult, especially because even as an individual investor, if you're purchasing mutual funds or if you're working with an advisor, the advisor nor yourself have control over what the mutual fund is doing internally. You also can see what's happening internally. You can see the reports, but you don't know what the liability is, like you said, Dad. So sometimes you get a little bit of a surprise, especially it seems in volatile markets because active managers are making active trades, which means you could run into a situation where you don't see a huge net asset value increase, but you still have a tax liability to deal with. So as we seem to be in a consistent volatile market, meaning we see great periods of stability, but every year seems to have some heightened volatility, that could be an ongoing new component of mutual funds held outside of retirement accounts, is that you're just going to see some excess tax liability there.
And I think at the end of the day, it makes sense, like most folks do while they're in the midst of purchasing, they're paying for their home. They escrow taxes. They're setting aside money.
Either they're doing it directly in each payment, or they're saying, we're going to set money aside and doing their own escrow.
Exactly. And if you do that, then you don't get caught without a Kleenex at the end of the year because you're crying into your soup.
Crying into your soup
for the
taxes.
Which is fine. But again, our phone lines are open. We'd love to hear from you, 314-931-5877 or 84126 from text line. Are we going to...
I think we should take our second break.
I think we should, so don't touch that dial. We'll be back with more Straight Talk on Retirement right after these brief messages.
The views and opinions expressed in the preceding paid program are those of the host, callers, and guests, and do not necessarily reflect the views or positions of this station, its management, or owners.
This is the Big 550 KTRS St. Louis, Alton, Valley Park, St. Charles, and the world.
Streaming live at KTRS.com.
I've been asked to say a word about Allen Roofing. That's not fair. I can't say it in a word. If they just did roofs, I probably could. I would say roofs. But they can do siding. They could replace it. They could put leaf guards on. They could reattach it like they had to do for me, where my gutter kind of came away from the house. Siding issues, they carry James Hardy, the very best. They can fix that too. Basically, if it's something you could see from the outside of your home or your office, they can fix it, improve it, or replace it. Look, it's probably the biggest investment you're ever going to make. Protect it. Absolutely. And nobody does it better than Allen Roofing. Check out all the reviews online. Everybody else seems to know. I shouldn't have to tell you these things. For all of your roofing needs and so much more, Allen Roofing. Find them online at aroofing.net.
This is Erin Lapidus, the retirement coach. Wouldn't it be great to have a game plan, a real strategy, so that no matter what was going on in the stock market, the economy, or the world, you could be confident about your retirement? Wouldn't that be great? If you're within 5 years of retirement, call me today at 314-863-0008. That's 314-863-0008. or send me an email at erin@jblfinancial.com to arrange your free coaching session. Let's get started on your retirement game plan today.
I'm Mark Miller, owner of Miller Furniture and Mattress, your home for quality American-made furniture since 1927. We offer the largest selection of Amish-made furniture in the St. Louis area, plus quality living room furniture from Flex Steel and Smith Brothers. We carry top-quality mattresses from world-famous brands like Tempur-Pedic, Stearns & Foster, and Chatham & Wells. Shop our Belleville, Fairview Heights, Lake St. Louis, and Ellisville showrooms. At Miller Furniture, we put the family in furniture.
Now, back to Straight Talk on Retirement on the Big 550 KTRS. Here are Jeff and Erin Lapidus.
Well, welcome back to the last segment of our number one of Straight Talk on Retirement. I'm kind of excited.
For hour number 2?
Absolutely, and I know we're going to have we're making the show into hopefully some type of a YouTube video.
Yeah, we're going to have, we won't be able to simulcast because we need to have everything recorded. But
well, I'm just thinking that we ought to be asking about, which of my dad's hats do you really like?
Okay.
I'm going to do my hat collection of the week. What do you think?
I think what we'll do is we will talk to our marketing team, and maybe we'll have some polls put up on the Facebook where they can vote on which hat you wear every week.
I have great hats.
And that just means, guys, if there's specific,
as in baseball caps,
if there's specific caps you'd like to see, because my dad has not done any Roth conversions, he has some extra cash. So if we need to purchase the hats, you can add.
I have a great collection.
He does have a good. Many of you have seen through the years Superman, Batman, all the
Spider-Man,
heroes.
The Flash.
I'm mostly a DC guy, so
okay. So if
we got to get him a Homelander hat.
Yeah, if anybody watches The Boys, that's a good one. That's like the new twist on superheroes. So don't hold back.
Yes, and again, our phone lines are open. We'd love to hear from you. 314-931-5877 or 84126 from the text line.
And our next texter writes, "Good morning, guys. Love listening to the show. I'm getting ready to retire in the next couple of years, and much of the literature that I consume seems to be concerned with having a predetermined amount, but that does not seem at all to be your approach at all. So who is right? Are they right that I need a predetermined amount of money, or are you right and I never hear you speak about it?"
Well,
they are never right.
First of all, who is they? No, but
exactly.
I would say that I think it's not that we don't discuss a specific number, because there isn't a single esoteric number that's going to fit everybody's single person.
Everybody's life has a size.
But let's go through the magic formula, which they don't talk about because
they don't have it, but we do.
They need to listen to the show,
and you will have it, our texter and everyone listening, in just mere moments. Let's figure out number one, the most important number of all the numbers. How much money are you spending every month? This is not, and this is great because just a couple of days ago, and I've been waiting to talk about this.
Great.
So I had a really very great first appointment with some longtime listeners to the show I think it was on Wednesday or Thursday of last week. And not only are they famous in our minds, but they're actually probably famous with all of the listeners as well. Because if anyone remembers the origin of Team Jeff, I met the author. Now, we all thought it was you, Dad.
I still think it was me.
I think it's so good that you thought it was you. But our texter was, I guess... Claim,
which is cool.
Saying that not only, he sparked the conversation that created Team Jeff, which was giving us a hard time about no grandchildren for
what
the retirement coach yet, but nonetheless. Anyway,
get to work.
That was not the reason why. That was one of the
not
really
right
cool,
now, but get to work.
That was one of the really cool things that we met. That when we met this client, but what I really wanted to talk about was because they were longtime listeners. They came in with 3 budgets, 3 different options for me to look at. Option number 1 was bare bones, subsistence. I call that box of boredom retirement. This was, we keep the lights on and the AC, so we're not going to be in a hot box while we can't watch cable, but we cut everything out. This is how much it costs for us to eat and live in our house every year, basically. So that was I even said this at the outset to them. I was like, if we could meet this number and only this number, I would tell you that you don't have enough to retire.
Right.
Because
no bumps in the road.
Not only no bumps in the road, that's unrealistic.
Ramen's no fun to eat every day.
And also, you're going to cut everything out, including cable? Like, now you can't even just watch TV all day.
You could read books.
I'm just saying that's not an option that we would want to consider. So they gave us that option, though. They gave us option number 2, which is a lot of what we want, but not everything that we want. So we're willing to make some choices.
That's not fun.
That's also not... Hey... They wanted to retire.
I love them already.
Right, so they were like, we're willing to make some sacrifices, but I said, I'm not ready to make any sacrifices yet.
Exactly.
Show me your last budget.
Show me the money.
The last budget, and this is my favorite budget, it was titled Great Retirement. So this was, they put everything in, they put in a little extras, they did they listened to our show a bunch of times, and so they gave us these 3 budgets. Great retirement. I was like, we're starting with great retirement. Let's see I actually said first, where's the overlap between good retirement and great? They couldn't totally pinpoint everything, so I was like, let's just go with great retirement.
Well, so let me ask you, honey, how close was great retirement to their actual current net after-tax monthly paychecks?
It was a little higher because they added a few extra vacations in, but if we were being to the penny, I would say it wasn't more than $15,000 over what they're currently spending.
So I'm going to let you continue, but I just want to...
No, that was kind of the wrap-up, which was they gave us 3 options, and I said to them, you did perfect work here because this is the most important number we're going to work on. How much are you spending every month? So I said, let's take the great retirement number, and I think that worked out to $5,000 a month.
What the texter is referring to is what we don't do. You're thinking, how much can I squeeze out of my investments? How much can I squeeze? Our thought is, how much are you spending?
Right.
That's how we work back to the number. So as an example, if it was $4,000 a month,
mm-hmm.
$48,000 a year, if I have a lump sum of capital, whether it's retirement, non-retirement, etc., available for investment, how much do I need in terms of total capital to be able to pull out $48,000 using a 4% prudent withdrawal rate?
Right.
$1.2 million. Pretty simple. That's it.
So,
That's your number.
That's right. So let's give it a little slower, which is how much are you spending every month? Be realistic about that. Now let's reincorporate the expense of taxes. So let's gross it up by at least 20%.
There you go.
Now let's subtract out your fixed income sources. Social Security most likely is the number one fixed income source you're going to have. Maybe pension, maybe rental income. That net number is your monthly income need. That's how much you are short after your fixed income of what you need every month when you no longer have a paycheck. You're going to multiply that by 12 because that gives you the annual amount that you were short. Then you're going to divide that number by 4%, and that's going to give you the number that you need in order to make your retirement comfortable. So we do have a number. It's just different for every person. So unlike the literature that works the opposite way, take 80% of your gross pay, take this number, take that number. You need 4 times this, 5 times that. No. Let's look at your life. The easiest way to look at your life is how much are you spending every month. Let's be realistic about that, meaning you may be able to cut things out, but let's start from the top where you don't have to cut anything out.
Because we know that you really don't want to. If you did want to, it would have
already be gone. Exactly.
And then the only other final capital component we would add to that is if you have specific capital expenditures you plan on making in the next 2 to 3 years.
Because we won't have time to plan for that.
Right.
The future.
Right. A car, a home renovation, some type of a significant, maybe educational obligation to a child, grandchild, whatever it would be.
Right. Because in the first year of retirement, we don't have time to plan for what you need immediately, whereas ongoing, we will have time to plan. So 5 years from now, we're gonna need a new car, this, that kind of thing.
But if we're going to take that money out of the kitty, right?
Right. We're going to take that out of the total to make sure from day one you still have enough to do the things you want immediately, plus have ongoing income.
Right. So whatever we need to generate the income flow plus excess spending, that is the number that we will need. And it works. It's simple, and it works. And you know what also works? Hold on. For hour number 2 of Straight Talk on Retirement.
Welcome to Straight Talk and Retirement. Your no-hype source for financial advice and making informed choices about your retirement planning. Get on the phone to talk today at 314-931-5877 or text your question to 84126.
The opinions voiced in this show are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial advisor or tax advisor prior to investing. Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Private Advisor Group, a registered investment advisor. Private Advisor Group and JBL Financial Services, Inc. are separate entities from LPL Financial.
Now, here are your retirement coaches, Jeff and Erin Lapidus.
Welcome back, everyone, to hour number 2 of Straight Talk on Retirement.
That first hour just flies by.
It really did fly by.
No, we love it when the texters are engaged. And just as a reminder, we're going to go into our smart choices about your health care. But we haven't forgot about our text line, so we know that we haven't gotten to a few texts. We're going to circle back to that after our smart choices about your health segment.
You care.
Or as I like to say, because you care, we talk Medicare.
Well, let's talk. Let's talk about Paul, right?
Yeah, let's. Paul is a longtime Medicare client. He recently discovered his dentist was out of network. It all started back in March.
So that means that he must have a Medicare Advantage plan.
He does.
Okay, so Paul's a longtime Medicare client of ours on a Medicare Advantage plan.
All started back in March when Paul went in for a routine cleaning. He thought...
so back in March, this March?
Yep.
Okay.
He thought it would cost him nothing, and he was hit with a $120 bill.
That's not quite nothing.
Right. He was kind of shocked, and this was the first cleaning of the year, and he was used to getting at least 2 cleanings per year as long as he'd been part of the plan. But that wasn't even the worst of it. The worst of it was that his doctor told him, in addition to getting hit with that bill for the cleaning, that he also needed a crown.
So now he's got a $120 bill, plus now he's thinking, oh my gosh.
Right, and so he stopped and saw the accounts manager on the way out, and she told him, I said, I don't think your plan covers crowns. You may want to give them a call.
Okay.
Instead, Paul gave us a call.
Well, of course.
Exactly, and he asked if his plan still is his plan covered crowns, and why he has to pay for cleanings when they'd always been free.
So basically, what's going on with the dental?
Exactly.
Okay.
And, if they didn't cover crowns, he wanted to know, were there any plans that did? And let's backtrack. If you're on a Medicare Advantage plan and you've been getting free cleanings for the majority of the time you're on there, and now you get hit with a bill, I want to say good 85% your doctor has left the network.
So this is important because really I think this is the first year, 2026, that not only did we have a lot of changes to dental coverage with Medicare Advantage plans, number one, they weren't all good. There were benefit cuts with a lot of different plans, but also the dental benefits used to be relatively uniform, meaning how you access them was similar across all of the insurance companies. It was just the values were different. So, United was giving X $3,000, Aetna was giving $4,000, whatever the case was, but you were still getting similar treatment. Now, almost every company and even inside each plan is working slightly differently. How you access it, if there's a network requirement, if it's preventative and comprehensive. So there's a lot of changes. So I'm sure that many of you might be having these questions.
And just to break it down a little bit further, most HMO plans have a network of dentists that you can transact with. But if you go outside of the network, at that point, you'll be on the hook for either a portion and or all of those charges.
So if you're like Paul and you've already had a cleaning and you received a bill and you're like, why did I get this? Well, I'll just pay it because I got the cleaning. you might want to check to make sure, is your dentist in the network any longer, because that's going to be one of the number one reasons why you might have had to pay.
PPO plans, if for those that have them, are a little bit more liberal in the sense that you will have a network, but you have the freedom to go out of it. But how they cover those services for out-of-network dentists will depend on the plan. So,
and I think there's only a couple of plans that are actually allowing any out-of-network benefits be covered.
Absolutely, and I was going to just touch on one.
Great.
The Humana PPO has a $3,500 dental benefit if you use in-network dentists. Now, if you go outside and use, you have a dentist that is outside the network, at that point they will cover up to 50% to that $3,500 mark. So look at it as a $1,750 benefit.
Right, or you're going to it's either a $1,750 benefit or you're going to have to spend $7,000 to get the full $3,500.
Correct.
Got it.
Paul's plan discontinued comprehensive dental. So normally you're going to see your dental benefit is going to be split between comprehensive and preventative. A lot of the HMO plans are down to preventative only, so that means your cleanings, your x-rays, your exams, all of which Paul's plan covered, but unfortunately his doctor was outside the network. That's why he was hit with the charges. Comprehensive includes things like crowns, bridges,
fillings,
root canals, extractions, fillings, so on and so forth. Unfortunately, Paul's plan no longer covers those.
So preventative is what we all think of when you go in for your routine checkup, cleaning,
Correct.
exam, x-ray. Comprehensive is everything that aren't those things. So even if you're on the same plan that you were on last year, that doesn't mean the plan is the same anymore, guys. So you either want to take a look at your summary of benefits or give your professional a call before you go to the dentist just to confirm things so you're not surprised like Paul was surprised.
No, you don't want to get hit with a bill that you weren't expecting. So are crowns covered under any plan? The answer to that is yes.
Are they covered under Paul's plan?
Unfortunately not. But,
okay.
But let's back up a minute and let's just see if there's anything we can do for Paul right now as opposed to Paul waiting all the way till next year.
Wait, so... Okay, so Paul gave us a call, like, what's going on with the dental?
Right. First, we had to dig in and find out, what's what and who's who on his current plan.
So basically what we determined was he's going out in network. That's why his cleanings aren't covered, and he's not going to have coverage for that crown that he is in need of. But we're outside of annual enrollment. We're outside of open enrollment now.
Exactly. So, I had to ask Paul a couple of questions to determine if we were able to make a switch. And
so you're saying there's still a chance?
Possibly.
There's still a possible...
Depends.
Okay.
It all depends. I had to ask Paul, did you make any changes during the annual enrollment period? That's the annual enrollment period beginning in October, ending in December.
So did you make changes when most people know to make changes, October 15th through December 7th?
Did you do it, Paul? The answer was no.
Okay, no.
Okay. Check the one box. Secondly, did you make any changes during the Medicare Advantage open enrollment period that just ended from January to March 31st?
So January 1, March 31st.
The answer to that was no.
Okay.
So given those two answers, and because almost the entire state of Missouri is now under a FEMA disaster special designation for a special enrollment period, we were able to make the switch.
So to say it a little bit differently, at least in the state of Missouri, and with every zip code in St. Louis County, I believe you mentioned to me, has what is called a disaster-related special election. So that will give you the opportunity, if you live in one of those zip codes, to possibly make a change, because that's not the only qualifier. The other qualifiers are what you asked Paul, which was, did you make a change during annual enrollment? Did you make a change during open enrollment?
Had he answered yes to either one of those, it wouldn't. The fact that we're under a special enrollment right now because of a FEMA disaster would be inconsequential, would not make a difference because he changed during one of those enrollment periods.
And the reason for that is Medicare has allowed for these additional enrollment periods related to disasters because the idea is that maybe because of the disaster, you did not have time or the ability to make a change to your plan. So that would be negated if you had made a change to your plan. Well, unfortunately, you were part of a disaster, but you weren't enough of a part of it that it inhibited you from participating in an enrollment period. So if you didn't participate in the enrollment periods, if your zip code fits the FEMA disaster, then you might still have a chance. And did you tell me that it runs through June?
It runs through the end of June, so you have until June 30th if you reside in one of the zip codes that is effective. And I just looked yesterday, and most, if not all, of the state is under
this.
Yes, correct.
Okay, so that means that Paul has the because Paul said no, he didn't make any changes. He lives in that right zip code. He's got a chance to make another change.
He does. So what were we ultimately able to do for Paul? Well, the first thing we did was switch him to an Anthem HMO.
Okay, why did we choose Anthem?
Well, because they have a very robust dental benefit of $3,000 that is both comprehensive and preventative, and his dentist is contracted with the Anthem network, so now his cleanings will be provided for.
And did all of his doctors fit into Anthem?
Yes, they did.
And all his prescriptions?
And all of his prescriptions. And, added kicker, we were actually able to lower his max out-of-pocket from $4,200 to $3,500, so saving a little bit on that liability max out-of-pocket cost. So
but had Paul had any medical expenses throughout the year so far from aside from the dental bill that he received?
He hadn't, but that's a great point. If he had, those would not transfer over. So you switch plans and say you've spent $1,000 already in that old plan. That $1,000 does not follow you. So you're starting the clock over again. You're getting, on the other side of it, you're getting to take advantage of all the added benefits with the new plan, but you're not being able to bring those expenses you've already paid for along with you.
That's an excellent point. The only exception to that point is your prescription drug expenses. That $2,000 cap, that follows you if you make a move. So if Paul was filling some prescriptions, he was working towards that $2,100 cap that we have on prescription drug expenses this year, that will follow because that's federal. Your maximum out-of-pocket is set by a federal standard, but it's not controlled. So that means that you will lose all those dollars you spent on the medical side if you're making a change. So it's important to evaluate that. Now, maybe even if you had spent a couple of $100s to start the year, but you're someone like Paul that needs a crown, maybe the savings is going to offset what you've already spent. So it does make sense to do the math. Let's not just make changes because you're able to make a change. Let's have a specific reason and then be sure it's the right choice.
Absolutely. Change for change's sake is not how we want. So
you're saying that not only is Paul going to be able to lower his max out-of-pocket a little bit, which is great in the event that something else comes up for him. All his doctors are in the network. His prescriptions are still covered. Now his dentist is back in the network again. And that crown isn't going to be 100% covered, but he's going to have coverage for it versus having to pay 100% out of pocket.
Correct.
Sounds like a
that's pretty
Monopoly
successful
game,
Right, or like, we checked all the boxes.
I'm just glad in Paul's case that he was able to kick the tires on that plan before we got past June because, say he went in for his first cleaning July 4th, shortly thereafter. Now all of a sudden, you're out of luck because the special enrollment period has passed. So, going in there and finding out these things on the front end was going to save him some money on the back end, which is great because that's what we want to do. We want to save you more money in your pocket.
And I was also just going to say, as you were having this conversation, I was thinking, gosh, Paul, why didn't you call us during enrollment? Like either of the enrollment periods, only because we were able to lower his maximum out of pocket, get him some extra dental, which would have been great for January 1. And that's a great reason why, even though things may not have changed with you, things do change with these plans every year. So although you may love the plan that you are on, it might not exist in the way that you love it for the next year. So it is always important that you're reviewing during the predetermined enrollment periods, because if we hadn't had those tornadoes last year or some of the other extreme weather, this enrollment period would not be available. So this is a Paul lucked out, and we're really glad we were able to help him situation.
Absolutely. And we got one texter that chimed in, says, seems to me a dental provider enters a contract to provide services. They should remain in the network for the agreed upon compensation. Your thoughts? Absolutely. In a perfect world, I would totally agree with that. I don't know enough about how the sausage is made on the other side to determine whether maybe it was the insurance company that changed the terms of the agreement. Maybe there were some mitigating factors that, forced the provider to leave the network. I just don't.
There are rules inside the contract that would require the provider to stay for a certain amount of time. However, annually these contracts are renewed in most cases. Sometimes it's every 2 years, depending. Like, for example, United Healthcare signed a contract with Mercy for a 2-year period. The dentist usually sign maybe 1-year contracts because those dental benefits are changing every year. I believe what happened is that Paul's dentist left the network January 1, and Paul just didn't happen to know that that was the case, probably in the network last year. So they do have the freedom to make changes on an annual basis, which just means the Medicare Advantage plans, they are a little bit more legwork, but that's why you have people like Frank and Rob to help you with that.
Absolutely. And as my wife said, these plans do change every year. And I'm not saying that your particular plan will see drastic changes, but it never hurts to come in, have a cup of coffee, let's sit down, let's put eyes on the different plans, who you're seeing, what you're taking, find out if you're still in the best, most cost-efficient environment you can be in. Yeah. And it never a cost of you to sit down with either me, Frank, or Erin. It'll only cost you if you don't sit down with me, Frank, or Erin. So you don't want to get caught without a chair when the music stops.
And did we have any more Medicare text questions?
Not at the moment.
Perfect. So why don't we give everyone a moment to think on those questions? We'll take our first break of this hour, and when we get back, we have some text questions to return to from the first hour, so don't touch that dial. We'll be back after these messages.
This is the Big 550 KTRS St. Louis, Alton, Valley Park, St. Charles, and the world.
Streaming live at KTRS.com.
Hey, it's Heidi, and I feel very lucky to love where I live. And I know Lauren Risley feels the same. And her team at Lauren Risley Realty wants you to experience that same great feeling. One of their mottos at Lauren Risley Realty is love where you live or move. Dream homes are their specialty. Actually, they do a lot of things right, because when you buy or sell a home, it's not just a transaction. What the Lauren Risley team does is build relationships, and I've seen that firsthand. So if you have plans to buy, sell, invest, or just have a question about any of it, call Lauren Risley Realty, 314-775-0684. That's 314-775-0684. You can also email Lauren at hello@laurenrisleyrealty.com.
This is Erin Lapidus, the retirement coach. Wouldn't it be great to have a game plan, a real strategy, so that no matter what was going on in the stock market, the economy, or the world, you could be confident about your retirement? Wouldn't that be great? If you're within 5 years of retirement, call me today at 314-863-0008. That's 314-863-0008. Or send me an email at Erin@jblfinancial.com to arrange your free coaching session. Let's get started on your retirement game plan today.
You know, over the years, Lordo's has become part of the family for many, many St. Louis families. For 80 years, they've been helping St. Louis families with all of the jewelry needs, whether it's the diamond ring, a diamond ring, maybe something for St. Patrick's Day, something for an anniversary, Valentine's Day. Throughout the years and throughout the calendar, it's Lordo's as your go-to. Whether it's men or women, you want to repurpose something or buy something new, Lordo's Diamonds in the heart of Ladue on Clayton Road. You see, it's a family business. The family's been running it for years, and they learned it from their father, who learned it from their father. And so that family jeweler, it's where generations of St. Louisans go. Grandparents have gone there. Your grandkids will go there. Right there in Ladue on Clayton Road, across the street from a Norman Rockwell-esque firehouse, is Lordo's Diamonds. Go in, make a friend, and make them your family jeweler, because you can thank me later. 314-432-8008, or online, lordosdiamonds.com.
Before you put your home on the market, before you have to pay money fixing it up to sell it, before you have to pay real estate commissions, call me. I'm Mike Robinson with Robank Properties, and I will buy your home. Any property, any condition, anywhere, and always as is. Call me, Mike Robinson with Robank Properties at 314-283-0867. That's 314-283-0867. You have nothing to lose when you call Robank Properties at 314-283-0867.
Now, back to Straight Talk on Retirement on the Big 550 KTRS. Here are Jeff and Erin Lapidus.
Well, welcome back to the show. We're almost halfway through hour number 2. It's 10:24 here on the Big 550. Our phone lines are open. We'd love to hear from you. 314-931-5877 or 84126 from the usually hot and heavy active KTRS text line. We do have some from the last hour. Is that correct?
We do. And our next texter writes, when rebalancing a portfolio, what factors do you use when determining what changes to make?
Well, I think that's we look on this in a couple levels. Level number one is certainly we're looking at your mix between stocks, equities, bonds, and cash. Your basic mix, or how far are we from that mix? Number two is I know that from a tactical perspective, we also like to look at the international side, emerging markets versus developed markets, etc. And then thirdly, we're also looking at, from a tactical point of view, is emphasis. Are there certain areas that we might want to consider adding some extra emphasis in, whether it's on the fixed income side, whether it's a sector like tech as an example, in the portfolios on the rebalancing. And then finally, obviously what we're doing is we're looking at cash needs.
And we would say, I think you've put that in a perfect hierarchy, because mix is the number one determinant of what your performance will be. It's not what you own inside of the mix necessarily. So first and foremost, it's mix, because that not only incorporates your risk tolerance, but it's also going to help us determine your result. It's going to help us guide the results.
Yeah, and what it does is when we get you to a portfolio configuration, whether it would be growth or growth with income or balanced or conservative or moderately conservative, we can then test your portfolio against benchmarks that have been created.
Like the S&P?
Right, like the S&P, et cetera, or a combination of the S&P and the Lehman's Bond Index, et cetera, to max that mix so that we can see how the performance is doing. And that's important too. Right,
so I think, like you said, first it's going to be mix, then it's going to be emphasis inside the mix. Are we creating concentrations? Are we alleviating concentrations that we once had in the past? Just like we're seeing the broader market when we're listening to commentators mention, first we had a narrow market. It was driven by technology and a very narrow number of companies, about 7, that were leading the market and also pulling the rest of the market along with it. Over the last several months, we've seen what we call rotation out of tech and into other parts of the market. So this could be your opportunity to say, as I rebalance, maybe I'm following what the market is doing, and I had a concentration somewhere. I'm going to broaden out our concentration I think it was just prior to the Iran conflict, the equal-weighted S&P 500 was outperforming the S&P itself, and that can be confusing to people because how does the index outperform itself? Well, every index that we refer to, the Dow, the S&P, the NASDAQ, even the CFA, which is the international index, they're weighted. So that means market capitalization of the company leads to the size of that of the index that they take up. So the equal weight was reflecting that we no longer have such a concentration in certain securities any longer, because the companies that were making up larger portions of the index were not performing as well as the overall index itself. So that's kind of an example, I would say, of how maybe you want to look at your portfolio.
The other thing I would do is refer back to our March newsletter, where we had a discussion about how international securities were outperforming had outperformed U.S. securities in the last 12 months, and it happened for a couple of reasons. And one of the primary ones was because the dollar isn't being as defended as much as it had been previously.
Right.
So what happened was that those currencies, international currencies, became more valuable against the dollar, which is sort of their second component of return. One is obviously the earnings of the companies in that portfolio, but also the conversion on the between the dollar and those other currencies. So there are things to look at. You know, it's a little bit more sophisticated than put the newspaper up on the wall and throw darts.
Sure, but when most people think of rebalancing, they are, especially if they are rebalancing, for example, if you're using, if you're still inside of your 401k, maybe you are just returning to your original mix, meaning you were in a portfolio that was 70% equities, 30% bonds and cash. Well, before we got to our correction this year, you might have seen that you were 75% equities, now 25% bonds and cash, and you want to pull back. You want to get back to 70-30. Means we're going to take 5% off of the top from your returns in the equity portion and move that to the fixed income to return back to that 70-30 mix. You may not necessarily be making adjustments to the underlying securities. That's what I think becomes the more technical conversation.
Absolutely. And again, if you blink your eye, March was a bummer. April's heaven. Right?
This is true.
For now.
For now, right. There's usually at least 1 to 2 dips in the year.
Yeah.
And again, as I've said, that I like to say to clients, one of our jobs, and it isn't our primary job, but one of our jobs is to say, let's hold the line and determine whether or not this is a pothole that we're going through or if it's a crater.
Like that.
And that's what we want to do. We want to try to, as much as we can, make sense of it.
I think my favorite Jeffism is if you hear the whistle and you see the smoke, it's okay to step off the train tracks.
Yeah, it's okay.
And we've had a few situations like that.
Yes, and unfortunately each situation can be different, but they all feel the same when they're happening.
Yes.
And I think our Medicare segment certainly
spurred some questions.
It did, and our next texter writes, it sounds like the patient should ask the dentist staff up front before getting the service in case the dentist goes out of network. Personally, I think the dentist office should have sent out notices when they were going out of network.
I personally agree with that.
I do.
And they may have, and it's just that the person just thought, oh, junk mail.
Could be, but I don't see that. I think that is a great point.
Or the mail never showed up, which is even more possible.
And I would say it never hurts as you are going, if you're using any provider, to just say, I'm in network, correct?
Confirm.
Right. Please, can you confirm I'm in network? Can you confirm this service is covered? There is a difference between asking how much this is going to cost and is this covered? Is this covered means that the insurance company is going to run it through the system that doesn't make it free or of no cost to you. I rarely like to say...
Or the truth is there's a contracted rate that the dentist has agreed to or whatever providers agreed to for that particular service. And that generally is a discount from, we will call it unreasonable yet customary rate. So you want to know.
Sure.
Before you go.
Exactly. Well put.
Yes.
You know before you go. And we have another texter that texted in and says, I have a dividend ETF yielding 11 or 12%.
Wow.
Which is a lot higher than the 1 or 2% that I believe you mentioned in the last hour. This seems pretty good, right? I would say so.
Yes, that would be great. I mean, we're not going to, we didn't mention the specific ETF. We don't know what it is. But if you're just comparing results, the average yields, that's a nice yield.
It's a very good yield, and I would want to know over what time period that is.
That's also an excellent question. Also, when we're looking at the full S&P 500, that's all of the companies that produce dividends off the S&P. Obviously, an ETF that's focused on dividend production is probably going to seek higher dividend yields, which means you could see concentration inside of that portfolio because there are a limited number of companies that are going to help you get to that higher yield. So there's always things to consider when you're making purchases of securities.
Yeah, and what's nice is with the ETF, you certainly have an opportunity to take a look at what the underlying investments are inside of those ETFs.
Make sure it's not over-concentrating you elsewhere.
Right. I mean, if you're looking at utilities versus tobacco has always been a high-yield industry, as an example, or Coca-Cola, et cetera. So,
also, it seems like some of the pharmaceutical companies are now paying decent dividends.
Yep. No question about it. So there's a place for all these things in your portfolio.
Yeah. Sounds like you picked a good one.
Very good.
Know what you own. Know why you own it.
That's an excellent. That's a good Robism.
And our next texter writes, if I leave my entire IRA to charity, will the charity have to pay taxes on it?
No.
No.
That's very generous of you. 501c3 companies do not have to pay taxes if they inherit IRA accounts, nor if you make distributions from your IRA account directly to the charity. You don't have to pay taxes, nor do they. If you donate highly appreciated securities to them when they sell them, they do not pay taxes on that either. So most 501c3s are fully tax exempt from your donations. So that means however you decide to leave them money, they'll receive it all.
So let's get a little twist into this.
Ooh.
Twisty.
Well, let's just assume that a person has created a will.
Okay.
Or a trust that says, I would like X amount to go to a charity at the time of death.
Just, they didn't say where, though?
Well, let's assume they chose a specific numbers of charities. They came up with dollar amounts that we would like this to be donated at death.
I meant from which account they didn't
never
mention that.
Mention where it's supposed to come from. So working with your advisor, I would probably say, let's not worry about the documents. Let's make the IRA a direct beneficiary from the IRA, so that the executor, who may not be a financial expert, they could be your child, they could be a cousin, they could be whatever. The money comes from the right place.
Well, because what you don't want to happen is, in that example, like let's just say that the estate was split $500,000 in IRA assets, $500,000 in non-taxable assets. So that could be property and after-tax money, whatever the case is. There's not taxes on that. So we're split 50-50. $100,000 is supposed to go to charity. You don't want 50 to come out of the IRA and 50 to come out of the after-tax money. You really want all of it to come out of the IRA, because then you can redistribute the rest of the $900,000 of assets appropriately for the balance of the beneficiaries. The IRA assets are going to go to the charity without taxes, but it's also going to alleviate tax burden on the rest of the beneficiaries if they are individual human beings.
Yeah, I think the problem is most executors that we've worked with don't really consider the tax efficiency of the distributions, what is going to where. And I think Erin's making a very good point. We know that individual securities, mutual funds, homes, virtually almost every other assets other than treasury bills and annuities that are owned in an after-tax account will step up the fair market value at the date of death. So all capital gains, if they're sold after that date, are forgiven. There's zero. That's the tax-free stuff. The IRAs are never in that category. So
unless you give them to charity.
That's right. So you want to give the taxable stuff to the people in the lowest tax brackets, which typically is a charity because they pay zero, and give the tax-free stuff to the people that are in higher tax brackets, which is human beings.
Right, and that also breaks it down further, as you talk about very frequently. Even if you're not donating to charity, but you're deciding how you're going to divide assets up amongst family members, in general, younger family members should receive the higher tax assets. Older family members should probably receive the less taxable assets because they're probably in higher tax brackets.
Yeah, and so to bring this down to something that's a little bit maybe more of a visual for you, which is what I use with everybody that we talk to. Imagine yourself having either a 2 or a 3-layer cake. The top layer being taxable assets, those that haven't been previously taxed, like your IRA. The middle layer, Roth, if you have Roth, that's tax-free. And then the bottom layer being your after-tax assets, which we know will be tax-free at the time of death.
Or very minimally taxable,
Most folks' documents say take a knife and cut up the cake all through all 3 layers, if you have 3.
So
okay.
every beneficiary receives a piece of each an equal piece of each layer.
Just like a 2-layer cake, right?
Yep. So if you're slicing vertically right down like you normally would slice a cake.
Got to grab the scoop.
That's right.
We need a spoon.
We need a spoon instead. We're suggesting what you do is we spoon out taxable assets to the folks in the lowest tax brackets, leaving a greater proportional amount to the folks that are in the highest tax.
So we literally removed the top layer. Now that still could mean
a portion,
and that still means that if you're thinking to yourself right now, well, I want my kids to have more than the grandkids to start potentially, or I want these people to have more, we can still divide it up that way, because if you think about it, maybe, if it's a spoon or whatever, so we just removed the top layer of the cake. You can redivide it however you'd like, leaving the bottom layer to be divided in its own way. So if we're still trying to balance out the estate, we still have the opportunity to do that. And you may find that there's actually more money to spread around, because when we go through when the kids inherit this and they have to pay a third in taxes, what did that do to the amount of money that they've received versus, no, they received the house, which is equal to X, and they received some of your after-tax assets. And that's going to be more valuable because it's no loss in taxes.
Right, honey. I mean, and really what we're getting down to at the very end of the day is that we need to include all of our assets in the cake. It isn't the house is separate really from the IRAs or from other stuff, etc. We need to really, if you think about it, best thing you could do is make a picture. I mean, literally make a picture. Put all of what's the value of all these other of each asset class. Let's decide how we really want to divide it up.
Because for most people, we're not looking at a perfectly round, perfectly equal cake.
Right.
The layers are usually different sizes. So we can think of them different sizes, like you got a size of a pizza and a size of a little cupcake, or thickness. It doesn't matter. The point is just that...
It's like Jello 3, 2, 1, except Grandma was drunk when she made it, so they're not the same.
Well, because most people spent the majority of their working career putting into IRA, so that means that usually we're seeing like anywhere between a 70 to a 90% split of IRA assets versus after-tax assets. And now I always like to joke, when we're talking about investable assets, we are never referring to your home, because we can't chop the garage off if you need long-term care. So you have to sell the whole asset in order to get the equity out of it. But when we are talking about inheritance, we do want to include the value of property. We do want to include the value of relatively what we would consider illiquid assets, because we're not talking about creating income anymore. We're talking about what are we passing on as your estate, and that house is going to be a valuable component, or the boat, or whatever the case is going to be a valuable component of how do we divide everything up in the most tax efficient way.
Well, honey, it's interesting because in fact, you taught me this lesson.
Ooh.
I remember.
Make note, everyone.
Well, I remember that my wife and I had a second home. We still have a second home, but we had a second home in Tucson, and I said, Erin, honey, if something happens to your mom and I, how long do you and your sister see retaining this house? She says, yeah, Dad, as long as it takes for me to walk to the phone, call the realtor.
It was just a very isolated home. Didn't.
Well, it's not really the point.
You're right. The point is that you love your stuff. Your kids don't necessarily love your stuff.
Exactly.
It's called Love Me, Love My Second Home.
Right. Well, and you have to be realistic. And for some folks, it's the same thing with a primary home. Are the kids going to move out of their house and move in? Probably not. So something to certainly have a discussion about, especially in an estate planning conversation.
That's a good one, because, and we've talked about the family farm frequently, right, because we have quite a few, we have quite a few clients, and I'm sure quite a few listeners that either have family farms or property in their family, or they're the owners of it. We have, and I was just a couple weeks ago sitting down with a client. They've got a couple of kids. One of them lives on the property that they own. They own a relatively large property. They have their personal residence. They have a few other buildings on it. It's a nice spread they have. They love it. The kid that lives on the property loves it. The rest of the kids don't.
They're not going to move back in.
They're not moving back in. And also, so Dad wants this to be a legacy property, wants it to stay in the family forever, want it to be so it cannot be sold. Mom she's a little more realistic in that everybody likes the property. Everybody loves that it's in the family. One of the kids loves it, lives on it. She said that's the only kid that understands what it takes to maintain this for everyone else to love it. Everyone loves it because when they come out, the grass is mowed and the kids can play and they can also go hunt and the barn's always ready for them to take the horse. All this stuff.
That don't happen on its own.
There are, as she joked, there aren't fairies that come and do all of this work. We do it. The kid that lives on the property does it. It's not going to be fair, one, financially to leave the property to the kid because it is one of their larger components. Even if we tried to break up the rest of their estate, the property itself is so valuable that we couldn't equalize everything. If, kid gets the property, everybody else gets everything else, couldn't equalize it.
Well, that's an issue of itself that we wouldn't have to deal with.
Right.
The second thing certainly is you want to deal with it.
Want to deal with it now.
Because if you don't, you're setting up a situation where, okay, one of the children says, you know what, this is nice, I want my money. Okay,
right.
Two of them say, I want my money.
Or it might go on for a couple years without that, but as soon as they get to the place and it's not the way it was and mom and dad aren't there anymore.
You got valuation issues, and then you also, what about a situation where, let's just say it's a multiple, and this is unusual, multiple children. One of them is obviously living on the property. They have children. They have no interest, but somebody else's.
A niece or a nephew has interest.
Right. Having the ability for them to buy back in. Maybe at some time in the future. Human legacy.
Right, and really the point of this is, because we're getting a little afield, is that you want to make these decisions now because, like that couple, the parent wants it in the family forever, never to be sold. The mom is more realistic, like, okay, well, I'd like the ability for the family members to be able to lay claim to it before they put it on the market. So I want a first right of refusal, but we need to be realistic that eventually, most likely, we're going to either have to break this up, so maybe the kid gets enough money to buy a section of the property and then they got to sell the rest. Whatever the case is, these are things you want to determine now for a few reasons. One, you want everyone to receive what you want them to receive. And secondly, you want to create a situation where the fighting is minimal. Because the last thing that anyone wants to happen is that all of the money ends up either in probate or a lot of it ends up being fought about and not really to benefit your family. And that's what we all want to do, right? Is enjoy our assets and then pass them on to continue to benefit the people that we love. And that's not the lawyers.
Planning is not always easy, but it's necessary. And whether, it's pleasant or not, better to do it today than later, period. I mean, it's good to vet these things out so that people know where they stand, especially when we're talking about family legacy property, a family business, whatever it might be, and then say, okay, if this is our game plan, then we've got to figure out, and especially with estate equalization issues, which frankly is fun game to play. There are always solutions.
We just played it last week with the life insurance with the business owner with the one son who wasn't part of the business. How do we equalize this?
So there are lots of strategies, but the first and most important thing, I think we talk about this in a lot of situations, not just the family farm, in all estate planning. If you first need to determine what you want to happen, what an ideal situation,
think that you have a blank slate. What is it you want?
Right. In a perfect world, it's not going to be perfect because you're not there anymore, but what would it look like? And then have the conversation not only with your advisor, but then it will be eventually time potentially to engage the attorney. But the first most important thing is you need to figure out what you want for your family, because it's sitting in front of the attorney to fight that out is not the time. You don't want to be on someone else's clock, especially when it's your dime. And you don't want the options to dictate what you want. You want to figure out what you want first and then let the options get you there.
Yeah, and I think it's so important that the conversation that Erin and I usually have, and Rob, that we have with our clients is, you're going to have to see the lawyer at some point in time. Let's get you ready by having these conversations first so that when you're sitting in front of him or her, we can talk about you can then talk about, you can communicate effectively what you want. They can also give you the pluses and minuses and other options so that you're not starting from zero.
And this is just like what we talk about. The tools are what get us to where we want to go.
Right.
They are not the solutions. The attorneys have tools as well. They are not the solutions. They're going to be the tools to get us to your solution. So we need to know where you want to go first.
Planning is fun. I mean, it really is fun because at the end of the day, you get the result that you want.
If you don't know where you're going, any road will get you there.
Well, that's a momism. You're really breaking them out today. But if you don't know where you're going, why don't we hang on through this next break and you can hang with us. So don't touch that dial. We'll be right back.
The views and opinions expressed in the preceding paid program are those of the host, callers, and guests, and do not necessarily reflect the views or positions of this station, its management, or owners.
This is the Big 550 KTRS St. Louis, Alton, Valley Park, St. Charles, and the world.
Streaming live at KTRS.com.
This is Jeff Lapidus, the retirement coach. Wouldn't it be great to have a game plan, a real strategy, so that no matter what was going on in the stock market, the economy, or the world, that you could be confident about your retirement? Wouldn't that be great? If you're within 5 years of retirement, call me today at 314-863-0008. That's 314-863-0008. Or send me an email, jeff@jblfinancial.com, to arrange your free coaching session. Let's get started on your retirement game plan today.
John Beal Roofing has been proudly serving homeowners and businesses in the St. Louis metro area on both sides of the river in Missouri and Illinois for over 3 generations. A dependable roof begins with a team you can count on, and that's exactly what you get with John Beal Roofing. Recognized as one of Roofing Contractor Magazine's top 100 roofing companies, John Beal Roofing offers 24/7 emergency service and industry-leading warranties, including a lifetime workmanship warranty for total peace of mind. From upgrading an aging roof or completing a full replacement, the team at John Beal Roofing delivers solutions that are built to code, built to last, and handled with expert care. John Beal also responds quickly with reliable storm damage services backed by decades of experience and 24/7 emergency support. Get started today for expert service and a free, no-obligation estimate by calling 1-800-NEW-ROOF. That's 1-800-NEW-ROOF.
My name's Dominic Badine. I'm calling from Massa's Italian Restaurant out here in St. Charles, and we've been a proud partner of KTRS throughout the years. We'd like to congratulate everyone at the Big 550 on their 30th anniversary, and here's to many more great years ahead.
Mom, what do you always say?
There's nothing sadder than jewelry that sits in a drawer.
That's why we are proud to offer jewelry repair on site at Newstetter's Fine Jewelry. We know that your jewelry is important to you, and we take that part of our job very seriously. Visit us at Doherty Ferry in Big Bend or learn more at wowdiamonds.com.
Let's talk about smart choices for your money. It's Straight Talking Retirement on the Big 550 KTRS. Here are your retirement coaches, Jeff and Erin Lapidus.
Welcome back to the last segment of our show. We've had a lot of fun this morning answering your calls as well as your texts at 314-931-5877 or 84126 from the hot and heavy. We'd love to hear from you. KTRS text line.
We really do appreciate those texts. Keep them coming. And our next texter writes, hello, would you please explain how provisional income taxation works? I'm 65, retired, working 1 day a week, and considering when to take Social Security. Thank you.
Sure. So the provisional income is how the IRS determines how much of your Social Security is taxable. So the calculation works like this. You're going to take 50% of your Social Security benefit and 100% of all of your other income, so your adjusted gross income. However, bear in mind, you need to pull back in non-taxable interest, so like municipal bonds, things that you were able to deduct, that you did not have to pay federal income tax or income tax on. Rather, you need to pull those back in. 50% of Social Security plus all of your other income. If you are married and filing jointly, if that number is less than $32,000, you do not pay taxes on Social Security. If it's between $32,000 and $44,000, you're going to pay taxes on 50% of your Social Security benefit at your tax rate. So that means 50% of the benefit will be taxable to you. If you are above $44,000 married filing jointly, then 85% of your Social Security will be taxable to you. That's the taxation component, but because our texter is 65 years old, still working and considering Social Security, you want to consider the income limitations as well. So, Rob, those ones do not have it doesn't matter if you're married filing jointly or single or filing as head of household. This is a straight number because it's tied to the individual. So if you are under your normal retirement age taking Social Security, how much can you earn in 1 year?
$24,480. And these numbers are adjusted every year, so that number will go up slightly.
For next year.
Exactly, about maybe 4 or 5%.
So that means that if you earn more than that $24,000 number, Social Security is going to take back $1 for every two that you earn over that number. So not only do you have to consider taxes of Social Security, you need to consider if there's going to be a take back based on the income. Now, you're working 1 day a week, so maybe you're not going to get there. But for everyone else that's considering it under normal retirement age, keep that in mind too. And then the last is the year you turn your normal retirement age. You can earn a little bit more than that, right?
Absolutely. The year you turn your normal retirement age, you're looking at $65,160.
And that take back gets a little better because you only pay back
one for every 3.
So
above
that 65 number.
Right.
Very cool. So keep those so 50% of your benefit, 100% of your income is going to help you determine how much of your Social Security is taxable. And then you got to.
There's a worksheet in your 1040.
Yes, there is.
That goes through that, and the big.
You know that now, huh?
Honey, I've known that for 25 years.
But I mean, personally.
No, I don't do the worksheet.
You didn't take the Social Security though.
Well, of course I did, but I knew it was 85%.
Oh, Mom does this. Mom does the worksheet.
Yeah, right. So the big deal here is you have to remember if you're in a situation where you may be shooting yourself in the foot because you're earning over the wage base and you're still working. You have to remember that you're freezing your Social Security benefit at that rate.
So you're kind of hurting yourself in 2 ways. You're not going to get all your benefit,
right,
and you froze your benefit.
And it may not be worth it. And in many cases, we talk to clients about, how maybe this is the time that we open the valve on your retirement income.
Right, because maybe you're not short your full benefit.
Or maybe if you're smart, if you actually have some time to plan, maybe what you're doing is stopping your retirement plan contributions, taking the money home.
And you've created a cash.
Right, creating a cash account that you can draw down for a specific period of time to make the numbers work. So lots of options. But again, there is a worksheet in your 1040 to go through this.
Perfect.
Cool.
There's got options.
And our next texter writes, "Good morning, guys. I'm just curious to know your thoughts on your clients' taxes. How big of an issue are their tax bills in retirement, and are you finding that taxes are a giant hurdle to cross to get to retirement?"
No.
I hate taxes for our clients. But
I don't.
What? I do. I wish that they wouldn't have to pay a dime.
I don't.
Well,
because look, somebody has to pay for the roads.
Someone else
for the military. For all the excess spending that Congress does. I mean, we need to.
Oh, I agree. They did that all while they were working.
I think the big deal is if our texter has any thought or received any information that taxes, if federal income taxes are higher in retirement than they are before retirement, I would
disagree with that.
I would burn it up, throw your computer out the window, whatever it is. It's just never. It really is never true because you have to consider.
Okay, you shouldn't say never.
Well, it's
rarely
almost
true.
Never. Almost never. I would say that 98% of our clients retire at a lower income rate, and the reason is that we're basing their taxable income on their after-tax spending, which generally doesn't include withholding for Social Security benefits, paying for health insurance, et cetera, lower income base. Lower income base, lower federal income taxes, plus you do have a few extra kickers. We have the Big Beautiful Bill that expanded benefits for folks that are over 65 and receiving their Social Security benefits.
You didn't have to receive, so just be over 65 earning less than $150,000 a year. You need a Social Security number.
And I would say that at least over 50% of our clients earn less than $150,000 a year.
So,
which is great.
I mean, I definitely agree with you on the premise, which is that we are finding that our clients are not finding that taxes are an issue not only to get to retirement, but in retirement because we're going to plan for them. Just like we talk about with our just like we talk about with our formula, how much are you spending every month? Let's reincorporate the cost of taxes back into that number. So that's going to be an ongoing component of it, just like having to eat, because we got to pay the taxes. So even though I don't love it for you guys, we are going to incorporate that into our planning to make sure that it doesn't become an issue in retirement at all.
And it's easy to see us if you like. Give us a call, 314-863-0008. Again, 314-863-0008. See you next week.
The opinions voiced in this show are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial advisor or tax advisor prior to investing. Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Private Advisor Group, a registered investment advisor. Private Advisor Group and JBL Financial Services, Inc. are separate entities from LPL Financial.
Be listening next week at 9 for more straight talk on retirement with your retirement coaches, Jeff and Erin Lapidus, on the Big 550 KTRS.